The newspapers called it efficiency. The politicians called it economic modernization. The CEOs called it unlocking shareholder value. In reality, it was the largest transfer of wealth from American workers to Wall Street financiers in modern history. Between 1980 and 2005, over 40,000 manufacturing plants closed across the American Midwest. Towns that had thrived for generations became ghost stories. Families who had built their lives around steady factory jobs watched their futures evaporate. The conventional narrative blamed globalization, automation, and market forces. The truth was more sinister. This is another story where money, power, and history collide. And nothing is ever as simple as it looks. The surface story seemed straightforward enough. American manufacturing was losing its competitive edge. Foreign competitors offered cheaper labor. Technology was making human workers obsolete. Companies needed to adapt or die. The free market was simply doing what free markets do. Wall Street had a solution. A new breed of financial firm emerged in the 1980s, armed with sophisticated models and bold promises. They called themselves private equity firms. Their pitch was seductive. Buy struggling companies, streamline operations, eliminate waste, and create value. Everyone would win. Investors would see returns. Companies would become profitable. The economy would grow stronger. The financial press celebrated these dealmakers as corporate doctors, performing necessary surgery on bloated American businesses. Business schools taught case studies about their methods. Politicians from both parties praised their entrepreneurial spirit. The mechanism was elegant in its brutality. Private equity firms would identify a target company, often a profitable manufacturer with valuable assets and steady cash flow. They would borrow enormous sums of money, sometimes 90% of the purchase price, to buy the company. This debt would then be transferred to the company itself, turning a healthy business into a heavily leveraged one overnight. The math was simple. Buy a company for $1 billion using $100 million in cash and $900 million in loans. Make the company responsible for paying back the $900 million plus interest. Extract fees for management and consulting. Sell off valuable assets like real estate and equipment. Cut costs by laying off workers and reducing benefits. If the company survived, the private equity firm would sell it for a profit. If it died under the weight of debt, they had already extracted their returns. The companies bore all the risk. The private equity firms captured all the reward. Michael Milken, the junk bond king, provided the financial innovation that made this possible. His high-yield debt instruments allowed private equity firms to borrow massive sums against future cash flows. Drexel Burnham Lambert became the engine that powered hundreds of these deals. The firm collected fees on every transaction. The more debt they could package and sell, the more money they made. The human cost was invisible to spreadsheets. In Akron, Ohio, a tire factory that had employed 3,000 workers for 60 years was bought, stripped, and closed within 18 months. The private equity firm extracted $200 million in fees and asset sales. The workers got 60 days' notice and a pension fund that had been raided to pay down acquisition debt. This pattern repeated across the industrial heartland. Paper mills in Maine. Steel plants in Pennsylvania. Furniture factories in North Carolina. Each deal followed the same playbook. Borrow heavily. Extract quickly. Blame market forces when the companies collapsed. The political system provided perfect cover. Republicans celebrated the deals as capitalism at work. Democrats focused on retraining programs for displaced workers. Nobody questioned the fundamental mechanism that was transferring wealth from productive enterprises to financial intermediaries. Regulatory capture made oversight impossible. The Securities and Exchange Commission was staffed with lawyers who planned to work for private equity firms after their government service. The Department of Labor had no authority over private equity activities. State pension funds, desperate for returns, became some of the largest investors in private equity funds, creating a perverse incentive system where public employees were funding the destruction of private sector jobs. The most sophisticated operators learned to game the bankruptcy system. They would load companies with debt, extract value through special dividends and fees, then guide the companies into Chapter 11 proceedings that would eliminate pension obligations and union contracts. The companies would emerge from bankruptcy as lean, profitable enterprises ready for sale to the next buyer. The scale of wealth extraction was staggering. Between 1980 and 2010, private equity firms generated over $2 trillion in transaction volume. The top 10 firms collected fees equivalent to the GDP of small nations. Their partners became billionaires while the communities they had hollowed out struggled with unemployment, drug addiction, and social collapse. The financial crisis of 2008 briefly exposed the fragility of the debt-fueled model. Several major private equity deals collapsed when credit markets froze. Companies that might have survived normal economic cycles were crushed by the debt loads their new owners had imposed. The government response was to bail out the financial system while allowing the underlying extraction mechanism to continue unchanged. The names have changed. The behavior has not. Today's private equity firms manage over $4 trillion in assets. They own nursing homes, hospitals, veterinary clinics, and retail chains. The playbook remains identical: leverage, extract, optimize for short-term returns while externalizing long-term costs. The COVID-19 pandemic created new opportunities. Private equity-owned hospitals received government bailouts while laying off nurses. Retail chains filed for bankruptcy while paying millions in management fees to their private equity owners. The crisis that devastated Main Street became another profit center for Wall Street. Modern private equity has perfected the art of regulatory arbitrage. They structure deals through offshore entities to minimize taxes. They lobby for carried interest tax treatment that allows their income to be taxed as capital gains rather than ordinary income. They have captured pension funds and endowments as sources of capital, making teachers and firefighters unwitting participants in the financialization of the American economy. The political response remains theatrical. Politicians hold hearings. Academics write papers. Journalists investigate individual deals. The system continues to operate because it serves the interests of the people who control it. Private equity partners donate to both political parties. Their portfolio companies employ millions of voters. Their institutional investors include the retirement funds of government employees. The original promise was that financial engineering would make the economy more efficient. The reality is that it created an extraction mechanism that hollows out productive enterprises to enrich financial intermediaries. The wealth that private equity firms captured did not materialize from thin air. It came from workers who lost their jobs, communities that lost their tax base, and companies that lost their future. The most chilling aspect is how the system has normalized its own brutality. Business schools teach private equity methods as legitimate financial strategies. The financial press celebrates successful deals without examining their human cost. The language of efficiency and optimization obscures what is fundamentally a wealth transfer from productive workers to financial rentiers. The corporate raiders who gutted Main Street succeeded because they understood a fundamental truth about modern capitalism. The people who control the flow of money do not need to create value. They just need to capture it. The rules they wrote ensured that they would always win, regardless of whether the companies they bought succeeded or failed. History shows us that financial innovation often serves to disguise ancient forms of exploitation. The private equity model is not a product of modern markets. It is a return to an older form of capitalism, where ownership means extraction rather than stewardship. The technology has changed. The fundamental relationship between capital and labor has not.